Welcome to the last lap of the Unpacking Transfer Pricing series. We have tried our best to keep the language lucid for everyone's consumption throughout the series, and today we will conclude this series with the Chapter 10 of the OECD Transfer Pricing Guidelines 2022, which focuses on financial transactions within multinational enterprises, ensuring they align with the arm's length principle. It examines how multinational enterprises can influence conditions like debt equity balance, interest rates, and profit distribution, impacting tax outcomes. This chapter provides guidance on ensuring financial transactions between associated enterprises align with the arm's length principle. It examines how multinational enterprise groups, MNEs, can influence conditions like debt equity balance, interest rates, and profit distribution, potentially impacting tax outcomes. The guidance respects jurisdictions' sovereign rights to address these issues under domestic laws. The Chapter 10 has been compartmentalized into different sections to address different subtopics within this chapter. Section B talks about the overarching guidance of Chapter 1, such as accurate delineation principles, which are crucial in financial transactions, determining if a loan is genuine or equity. Identifying commercial relations and economically relevant characteristics ensures compliance with arm's length principles. Section C touches upon treasury functions in MNEs involving intragroup loans, cash pooling, and hedging, while Section D is about financial guarantees that require separate risk assessment and arm's length conditions. While Section E, captive insurance companies, focuses on genuine business indicators and risk diversification. Section D, Point 1 of Chapter 1, emphasizes delineating actual transactions and identifying commercial relations in financial dealings. It guides on determining if a purported loan is a true loan or an equity contribution, considering arm's length interest rates. Article 9 of the OECD Model Tax Convention supports this by assessing whether a loan's interest rate is at arm's length or if it should be treated as equity. This chapter acknowledges the fact that local jurisdiction might have their own approach towards such intercompany financial transactions. Determining whether a transaction is a loan or equity involves examining key characteristics. Loans typically have fixed repayment terms, regular interest payments, and limited business control. In contrast, equity contributions often feature uncertain repayment, variable payments, shared risk, and significant control. Article 9 of the OECD Model Tax Convention guides this analysis, ensuring arm's length interest rates and proper classification. Accurate delineation of financial transactions involves examining MNE's group policies, such as funding prioritization, strategies, credit rating targets, etc. Analyze contractual terms, functional analysis, and economic circumstances to understand the actual conduct and economic principles. Risk allocation is crucial. Ensure the entity controlling risks has the financial capacity to assume them, aligning with independent enterprise standards. Analyzing financial transactions between associated enterprises requires examining economically relevant characteristics. Contractual terms should be explicit, but often lack detail, thus necessitating a review of documents and comparing it with actual conduct. Functional analysis involves identifying functions, assets, and risks. Financial instrument characteristics, economic circumstances, and business strategies must align with independent enterprise expectations to ensure arm's length conditions. We will look into these 5 key factors in detail in subsequent slides. Examining contractual arrangements involves analyzing written agreements, which are typically explicit between independent enterprises. However, associated enterprises may have inconsistencies between arrangements and actual conduct. It's crucial to identify economically relevant characteristics, like fixed repayment dates, interest obligations, and enforcement rights by the lender. Consider comparability, actual conduct, and commercial considerations to ensure accurate transaction delineation. In financial transactions, a functional analysis identifies the functions, assets, and risks, FAR, assumed by parties. Lenders analyze risks, commit capital, determine loan terms, and monitor loans. Borrowers should maintain repayment funds, provide collateral, and fulfill obligations. Risk allocation depends on control and financial capacity. If a lender lacks control, risks shift to the controlling entity. Financial instruments vary widely, impacting pricing. Key instruments include loans, leases, guarantees, and derivatives. For loans, characteristics like amount, maturity, repayment schedule, purpose, seniority, location, currency, collateral, guarantee, and interest rate are crucial. In the absence of these, the controlled transaction could be judged as an equity infusion. The closer these attributes match between controlled and uncontrolled transactions, the more reliable the pricing comparison. Economic circumstances significantly influence financial instrument pricing. Market conditions, such as central bank rates and credit crises, affect prices. Timing is crucial. Data close to the transaction is more comparable. Currency differences, driven by growth, inflation, and exchange rates, impact pricing. Regulatory factors like interest rate controls also cause price variations across markets. Take a moment to pause and read through if needed. Business strategies significantly impact transfer pricing terms. Lenders assess business plans and forecasts, acknowledging temporary financial metric changes. For instance, a 10-year loan for short-term capital may be reclassified as a 1-year revolving loan, aligning with industry norms. Accurate transaction delineation requires understanding economically relevant characteristics, including business strategies, relationship between the parties, identify recurring pattern in the similar industry to arrive at an arm's-length pricing. There are certain databases which can assist in this regard. The treasury function in M&E groups is crucial for managing finances, influenced by business structure, strategy, and industry. It ranges from decentralized, where each entity manages its finances, to centralized, with full control over transactions. Key roles include liquidity optimization, financial risk management, and strategic financial management, alongside managing external relations like debt raising and stakeholder engagement. Core treasury functions include liquidity optimization, ensuring cash availability in the right currency, and financial risk management through hedging and diversification. Strategic financial management involves long-term investment strategies and capital structure optimization. Extended activities cover debt and equity raising, and managing relationships with financial stakeholders. Treasury's role varies with multinational enterprise structure, balancing daily liquidity and long-term strategy. In financial transactions, identifying risk control is crucial. For instance, if Company B cannot service a loan taken from Company C, whereas after FAR analysis it is found that Company P, parent company of B and C, exercises the ultimate control and have the financial capacity, then Company P should bears the risk. The lender, Company C, receives a risk-free return. Entities controlling and assuming risks should earn risk-adjusted returns, considering premiums like default, business, and foreign exchange risks. Conduit units should get risk-free returns. Captive insurance companies, established by multinational enterprise groups, primarily insure group members. They offer potential tax benefits and risk diversification by pooling risks. Key considerations in transfer pricing include identifying commercial relations, accurately delineating transactions, and assessing risk allocation. These entities may be self-managed or managed by external providers, often mirroring commercial insurers' regulatory regimes. Captive insurance must demonstrate genuine business indicators like risk diversification, regulatory compliance, and insurability. It should pool risks from multiple entities, comply with regulations, and ensure risks are insurable outside the multinational enterprise group. Essential people skills and a real possibility of loss are crucial. These factors influence transfer pricing, distinguishing genuine insurance from tax planning. Risk assumption in insurance involves the insurer taking on the financial impact of claims. Captive insurance must have the capacity to satisfy claims, indicating genuine risk assumption. Risk diversification pools risks to optimize capital use, with internal diversification often less efficient than external. Group synergies should benefit all contributing multinational enterprises. Pricing captive insurance transactions involves several methods. The comparable uncontrolled prices approach uses similar arrangements between unrelated parties, requiring adjustments for differences. Actuarial analysis independently determines premiums, needing comparability adjustments. The combined ratio and return on capital method assesses profitability, adjusting for capital adequacy. Group synergy benefits enhance efficiency in reinsurance markets, necessitating benefit allocation among participants. This is very niche and hence needs more nuanced approach. Group synergy benefits in captive insurance arise when multinational enterprise groups access reinsurance markets, achieving cost savings and risk pooling. Captive insurance should be compensated for basic services, while remaining benefits are allocated among insured participants based on premium contributions. The synergy stems from collective purchasing, not the captive's value addition, exemplified by a manufacturing multinational enterprise group insuring against earthquake damage. This brings us to the end of the series, which we fondly named Unpacking Transfer Pricing. Remember to seek expert advice when taking business decisions. This series aimed to be informative and does not represent any entity, firm, or company whatsoever. Created with AI assistance, it strives for accuracy, but may lack expert nuance. Verify information independently and consult experts before decision-making. Until next time, stay curious.